$5,081. That's where gold is trading right now, today, March 6th, 2026. And if that number feels confusing to you, good, because it should. Because just 8 days ago, gold was sitting at $5,408 an ounce. That's a drop of more than $327 in less than 2 weeks. And in the span of a single trading session on March 3rd, this metal fell 6% in one day, the sharpest single-day collapse in gold since 1983. 1983. That was 43 years ago. Ronald Reagan was president. The internet didn't exist. And gold just did something it hasn't done since then. Now here's what's interesting. On that same day, gold was crashing 6%. A war was actively escalating in the Middle East. Iran was firing missiles across the region. The US had just launched strikes that reportedly killed Iran's supreme leader. And gold, the asset that is literally supposed to go yup during war, was going down. Hard. So either something is deeply broken in how this market operates, or there is a mechanism at work here that most people don't understand. And by the end of this video, I'm going to show you exactly what that mechanism is, what it's called, why it keeps happening, what it means for the price of gold going forward, and, most importantly, what you should actually do about it. Stay with me, because this is one of the most important patterns in the gold market, and almost nobody is talking about it clearly. Let me give you the full picture of what just happened this week, because the numbers are genuinely extraordinary. On March 1st, gold was trading at about $5,387. On March 2nd, it dropped to around $5,327. Then, on March 3rd, it fell off a cliff, crashing nearly 6% to a low of $5,018 in a single session, wiping out every gain from the entire previous week. Then it bounced slightly, clawed back to around $5,137 on the 3rd, hit $5,081 by today, March 6th, and it is headed for its first weekly decline in more than a month. Now, before I explain exactly why this happened, let me give you a quick message. My analytics show that roughly 3 out of every 4 people watching this video aren't subscribed. If this kind of analysis is cutting through the noise for you, if you're tired of hearing the same recycled headlines and you want to understand the actual mechanics of what moves these markets, hit subscribe right now. That's how I know who the serious people in this community are. It helps the algorithm put this content in front of more people who need to see it. Now, back to the gold market, because this next part is critical.
So what actually happened?
The official explanation from Bloomberg, Reuters, and CNBC goes something like this. A stronger US dollar pushed gold down. The Middle East war pushed inflation expectations up. Higher inflation means the Fed won't cut rates. No rate cuts means gold, which pays no interest, becomes less attractive. So investors sold it. That's the explanation. And it's not wrong technically, but it's dramatically incomplete. Because here's the thing. That explanation doesn't account for the speed, the violence, or the timing of what happened. It doesn't explain why gold dropped 6% in a single session, while simultaneously a major war was escalating. And it absolutely does not explain what happened at the CME Group, the Chicago Mercantile Exchange, in the weeks leading up to this crash. You see, this is not the first time something like this has happened, and once you understand the pattern, it becomes very predictable. It happened in March 2020, when gold crashed nearly 14% in 2 weeks, even as the pandemic panic was escalating. It happened in September 2011, when gold fell sharply in a single day after CME raised margins 3 times in 8 days. It happened in April 2013, when gold lost over $200 in 48 hours after a series of institutional sell orders hit the COMEX simultaneously. Same setup each time. Gold in a strong uptrend, volatility rising. CME steps in and raises margin requirements. Leveraged traders get squeezed. Forced selling cascades. Prices crash faster than the fundamentals justify. And then, this is the key part, the metal recovers and goes higher. Every single time. Let me explain what margin requirements actually are, because this is the engine behind what you just watched. When you trade gold futures on the COMEX, that's the division of CME Group where precious metals trade, you don't have to pay for the full contract up front. A single COMEX gold futures contract represents 100 troy ounces of gold. At today's price of around $5,000, that's $500,000 of gold. But you don't need $500,000 to control that contract. You post a deposit, a margin, which is a fraction of the total value. That's leverage. And leverage is a weapon that cuts both ways. Now here's where it gets interesting. The CME has the power to change those margin requirements at any time. When prices move violently, whether up or down, the CME typically steps in and raises those margins, requiring traders to post more collateral. On the surface, this sounds prudent. The The exchange is protecting itself from defaults, and that justification is technically true. But the practical effect is that when margins suddenly go up, traders who are already stretched thin get margin calls. A margin call means you have to deposit more money immediately, or your position gets liquidated, automatically, regardless of whether you think the trade is right, regardless of whether you believe gold is going higher. If you can't post the extra cash, your broker closes your position. And when thousands of leveraged traders get margin calls at the same time, they all sell simultaneously, which pushes the price down further, which triggers more margin calls, which forces more selling. It's a feedback loop, a cascade, and it is absolutely devastating to watch in real time. Now let me show you exactly what CME did in the weeks leading up to this crash, because the timeline is remarkable. On January 13th, 2026, that's less than 2 months ago, CME Group made a fundamental change to how it calculates margin requirements for precious metals. Previously, margins were set as fixed dollar amounts per contract. CME switched to a percentage-based system, where margins are calculated as a percentage of the contract's total value. They framed this as a routine modernization. According to their official notice, this was about ensuring adequate collateral coverage in view of current market volatility. And to be fair, gold had surged almost 65% in 2025 alone, its biggest annual rise since 1979. Volatility was high. The change made some mechanical sense. But then watch what happened next. That was January 13th. By January 29th, gold hit its all-time high of $5,594. Silver was trading above $120. And then the CME moved again. On January 31st, 2 days after gold's all-time high, CME announced margin increases across all precious metals. For gold futures, margins went from 6% to 8% of contract value. For silver, the increase was even more dramatic, from 11% to 15%. For heightened risk profiles, gold margins went from 6.6 to 8.8%, and silver went from 12.1 to 16.5. And then, and this is the part that should make you sit up straight, they raised them again. February 6th, 2026. For the third time in less than 4 weeks, gold margins went from 8% to 9%. Silver went from 15 to 18%. 3 margin hikes in 24 days. Let that sink in. 3 times in less than a month, CME Group made it significantly more expensive to hold leveraged positions in gold and silver. And as the Wall Street Journal confirmed, CME Group had raised margins for precious metals 3 times since January 13th, a pace of intervention that has no recent precedent in the precious metals market. Now I need you to understand the financial math here, because this is the smoking gun. When CME raised gold margins from 6% to 9% in stages, here's what that actually meant for traders. At 9% margin on a 100-ounce gold contract at $5,000, you need to post $45,000 per contract. At the old 6% rate, you needed $30,000. That's a 50% increase in the capital required to hold a single contract. If you were managing a fund with positions in, say, 500 gold contracts, which is not unusual for mid-size institutional traders, your margin requirement jumped from $15 million to $22.5 million overnight. And if you didn't have that extra $7.5 million sitting around in cash, your broker started liquidating your positions automatically. Now multiply that across the entire market. According to Reuters and Bloomberg coverage from January 30th, gold's sharpest one-day drop since 1983, 9.8% in a single session, was described explicitly by analysts as driven by exactly this margin feedback loop. Bob Haberkorn, senior market strategist at RJO Futures, described the move as driven by a flight to liquidity, a flight to cash, with the strong dollar and higher bond yields combining with the margin squeeze to force selling. And another analyst cited in Reuters coverage put it even more plainly, describing it as a feedback loop where falling prices trigger margin calls, which force more selling, which drives prices lower still. But here's where this story gets genuinely fascinating, because what happened on the CME, in the paper futures market, was completely disconnected from what was happening in the physical gold market. And I want you to really pay attention to this section, because this disconnect is one of the most telling signals in the entire precious metals landscape right now. While paper gold was crashing on the COMEX, the physical market was telling a completely different story. Let me give you the COMEX delivery data, because this is publicly filed and you can verify every number I'm about to give you. According to CME Group's official delivery reports, in December 2025, COMEX processed 37,003 contracts for physical gold delivery, equivalent to 115.1 tons of actual gold. And that came after October 2025 set an all-time delivery record for any active month at 197.5 tons, more than 5 times the historical average. Every single contract month in 2025 set a new delivery record. The market was not just speculating on gold, it was demanding the actual metal. Now look at what happened to COMEX warehouse inventories through that same period. Between December 2024 and March 2025, COMEX warehouse stocks surged from 17.1 million ounces to an all-time high of 43.3 million ounces, a 153% increase in just 4 months, driven by traders flying gold from London and Switzerland to New York ahead of potential tariffs. Swiss refiners were reportedly airlifting gold to the U.S. almost daily. But by February 2026, according to MacroMicro's COMEX inventory tracking, those stocks had pulled back to approximately 34.4 million ounces, a decline of nearly 9 million ounces from the peak. And registered inventory, the gold actually tagged, warranted, and available for immediate physical delivery, had compressed further still. Physical supply tightening, even as paper prices were being hammered by margin mechanics. Now I want to add one more piece of physical market data that is genuinely extraordinary. The World Gold Council, not a conspiracy site, not a YouTube channel, the actual World Gold Council, reported that global physically backed gold ETFs posted a record inflow month in January 2026, $18.7 billion in a single month, led by North America and Asia. $18.7 billion chasing physically backed gold in 1 month. And the World Gold Council also confirmed that net central bank gold demand totaled 230 tons in the fourth quarter of 2025 alone, finishing what they called a year of durable buying activity, even as prices hit record highs above $5,000. 230 tons in 1 quarter. That's sovereign governments, central banks, reserve managers, the most sophisticated and patient buyers in the world, buying physical gold at the highest prices in history. They're not trading paper futures. They're not speculating on leverage. They're taking delivery of actual metal and putting it in their vaults. And they're accelerating the pace as prices rise, which tells you something very important about how the institutions that manage the world's reserve assets view the value of gold relative to the currencies they're holding. So now let me walk you through the timeline of this specific week, because it illustrates the paper versus physical disconnect perfectly. On March 1st, the Middle East war was entering its 3rd day. U.S. and Israeli forces had struck Iran. Khamenei was reportedly killed. Iran was firing missiles across the region. Brent crude topped $80 a barrel. Gold initially surged, up nearly 5% across 2 trading sessions, per the World Gold Council's own market commentary. The metal hit above 5,400. But then on Tuesday, March 3rd, the paper market dynamic flipped entirely. As Bloomberg reported, the dollar rallied sharply. Treasury yields rose for a second consecutive session. The U.S. dollar index posted its biggest weekly gain since November 2024, up 1.3% in a week. And here's the cruel math of a strong dollar. When the dollar strengthens, gold, which is priced in dollars, becomes more expensive for buyers using euros, yen, pounds, or yuan. You need more of those currencies to buy the same ounce. Foreign demand weakens. And simultaneously, with Treasury yields rising, the opportunity cost of holding gold, which pays no yield, goes up. Institutional investors who hold both treasuries and gold start rotating. Not because gold is fundamentally less valuable, because the paper market math changed. And then comes the detail that really crystallizes what's happening. ING Bank commodity strategist Eva Manthe noted that some of the gold weakness looked driven by equity-led risk moves, with investors using gold as a source of liquidity to cover losses in the U.S. stock market. Think about what that means. People selling their gold to raise cash to meet losses somewhere else. Gold being used as a liquidity buffer, not as a hedge, not as a store of value, but as an emergency ATM. That's the paper market. The physical holders, the central banks, the ETF investors, the allocated bullion accounts, were not selling. The leveraged paper traders were. Stick with me because this next part is critical. I want to ask you a direct question. If you have 2 markets for the same underlying asset, a paper market where leveraged traders are selling en masse under forced liquidations to meet margin calls, and a physical market where central banks are buying 230 tons per quarter, ETFs are recording record $18 billion inflow months, and COMEX physical delivery demand ran at 5 times its historical average all through 2025. Which one is giving you the true price signal? Because right now, those two markets are telling you completely different things. The screen says $5,081. The behavior of the world's sovereign buyers says the metal is worth considerably more than that. One of these is pricing reality. The other is pricing a leverage squeeze. And history is very clear on how this resolves. In March 2020, paper gold crashed from around $1,700 to $1,477 in 2 weeks as margin calls and liquidity needs drove forced paper selling. 8 months later, gold hit $2,075, a new all-time high. In September 2011, CME raised silver margins 3 times in 8 days. Silver collapsed from above $48 to $26. Gold got caught in the undertow. Both recovered and moved to new highs over the following cycle. In April 2013, gold dropped over $200 in 48 hours on what was later scrutinized as coordinated institutional paper selling on the COMEX. The metal eventually recovered. 13 years later, we're trading at $5,000. The margin trap pattern is this: strong rally, volatility spikes, CME raises margins, leveraged longs get squeezed, paper prices crash, physical buyers absorb the selling, prices recover and go higher. Every single time. Let me name some specific institutional names here because this isn't abstract theory, it's documented in public filing data. According to COMEX delivery records for December 2025, Wells Fargo's proprietary desk absorbed 42,900 ounces in a single December 19th settlement, a $187 million physical gold commitment in 1 day. Morgan Stanley ran a parallel accumulation of 44,000 ounces in the same period. HSBC and ADM were also taking sustained customer stops. These are not retail speculators. These are major financial institutions taking physical delivery of gold at the precise moment that leveraged paper traders were being forced out of their positions by margin calls. Meanwhile, on the speculative side, managed money long positions in silver on the COMEX collapsed 77.72% year over year, from 54,415 contracts in February 2025 down to just 12,121 by February 2026. That is a destruction of speculative leverage on an almost industrial scale. The weak hands got washed out. And what filled the vacuum? Industrial users. According to February 2026 delivery data, the rate of contracts standing for physical delivery was running 12 to 22 percentage points above historical norms, meaning real-world buyers of actual metal were stepping in immediately on first notice day rather than rolling their paper positions. They wanted the physical metal, not the paper promise. So what does all of this actually mean for you, right now? I want to be crystal clear that nothing I say here is financial advice. You need to make your own decisions based on your own circumstances, and please consult a qualified financial professional before making any significant moves. That said, let me walk through what the data implies. First, understand what you own. If you hold paper gold, futures contracts, leveraged ETFs, contracts for difference, you are directly exposed to the margin dynamic I've described. When CME raises margins again, and based on the pattern they will if gold makes another strong run, your position can be liquidated regardless of whether your long-term thesis is correct. You can be absolutely right about gold going higher and still get wiped out in the short run because of margin mechanics. That's not a failure of your analysis, it's a feature of the instrument you're using. Second, physical gold is not affected by margin calls. Not at all. The central banks buying 230 tons in Q4 2025 don't get margin calls. The ETF investors who put $18.7 billion into physically backed funds in January 2026 don't get margin calls. Their metal doesn't get liquidated because CME changed its collateral requirements. This is the structural advantage of owning the physical asset that no paper product can replicate. Third, watch the dollar over the coming weeks. The current gold weakness is heavily driven by dollar strength. The dollar index up 1.3% in a single week is significant. If the dollar starts weakening as the geopolitical shock fades, which the World Gold Council's commentary explicitly suggested is the most likely near-term trajectory, that removes the primary headwind. Fourth, watch the Fed and inflation data. Swaps traders are now pricing in only about 35 basis points of rate cuts by year-end, down from 60 basis points just last week. The March 11th CPI print is critical. If energy-driven inflation comes in hotter than expected, and with Brent crude above $80, that is entirely possible, it could push rate cut expectations even further out, which is a near-term headwind for gold. But that same inflation is a long-term tailwind for physical metals. Fifth, watch COMEX registered inventory. As deliverable supply continues to compress while physical demand stays elevated, the gap between paper market pricing and physical reality grows wider. History says that gap closes in the direction of physical, not paper. Sixth, watch the geopolitical trajectory. Swiss bank UBP noted that gold has substantial room to challenge its record high above $5,595 if the Middle East conflict extends for several weeks. President Trump has publicly signaled the operation could continue. A deepening conflict reasserts the war premium currently being overwhelmed by dollar and rate dynamics. And seventh, don't panic sell physical precious metals during paper market crashes. This is exactly what the margin trap is designed to make you feel. The leveraged traders margin called on January 30th when gold crashed 9.8% in a single day. Many of them sold right at the lows. Gold recovered. Physical holders who sat tight are still holding metal that's up over 17% year to date even after this correction. Let me bring this full circle because I want to leave you with the clearest possible picture of where we stand. Gold started 2026 at approximately $4,341. It surged to an all-time high of $5,594 on January 29th, a gain of over 28% in less than 30 days. Then, CME raised margins 3 times in 24 days. The paper market collapsed. Gold fell nearly $900 from its peak. It sat near $4,700 on February 2nd. Then, it recovered, climbed back to $5,408 on March 2nd, as the Middle East conflict triggered safe haven buying. Then, the dollar surged, yields rose, equity investors sold gold for liquidity, and the paper market sold off again, crashing 6% on March 3rd in gold's worst single-day performance since 1983. And today, March 6th, 2026, gold sits at $5,081. Still up 17% on the year. In a market that has absorbed 2 violent, margin-driven corrections in 2 months, that underlying resilience is telling you something. The structural buyers are not leaving. Central banks are not leaving. ETF inflows are not leaving. Physical delivery demand is not leaving. The people who look at what happened this week and conclude that gold is broken, they're looking at the paper market and mistaking the shadow for the substance. The margin trap is not a sign that gold has failed. It is a mechanism that has consistently been used during gold bull runs to shake out the leveraged players, reset positioning, and create the conditions for the next leg higher. It happened in 2011. It happened in 2013. It happened in 2020. It happened in January 2026. And it appears to be happening again right now. I'm not telling you the next leg higher starts tomorrow. There are genuine near-term headwinds. Dollar strength, elevated yields, potential for the Fed to hold rates longer than expected. Those are real, and you should account for them. But they are cyclical factors. The structural story hasn't changed. And every single time this margin trap has sprung in the past, the physical market has ultimately won. Drop a comment below and tell me, are you currently holding physical gold, paper gold, or both? And did this week's drop change your positioning at all? I read every single comment. Your perspective genuinely shapes what I cover next. Are you seeing this as a buying opportunity? Or are you waiting for the dollar and rate picture to clarify before making a move? If this video helped you understand the mechanics behind what just happened, beyond the surface level, dollar up, gold down explanation, share it with someone who needs to see it. The more people who understand how the margin trap works, the fewer people get caught in it. I'll be back with a full update the moment the next major signal hits, the March 11th CPI print, any new CME margin announcement, or a significant COMEX inventory move. Until then, do your own research, talk to qualified professionals, and keep watching the physical market. That's where the real signal is.